Right now, you have some amount of money in a bank account. Here's the question: where is it? Not which bank, not which app. Physically, right now, the actual money. Where is it sitting? In the next 10 minutes, we're going to open a bank. Not a metaphor, the actual balance sheet of every commercial bank in the United States, published every Friday by the Federal Reserve. We're going to find your money in it. We're going to count how much of it is actually there. Then we're going to answer 3 questions. 1, where the other part went. 2, who created it in the first place, because it wasn't the government. And 3, what the bank is paying you to hold it versus what it's charging someone else for the exact same dollar. By the end, the number on your screen is going to mean something different than it does right now. Every Friday, the Federal Reserve publishes a release called H.8. It's the combined balance sheet of every commercial bank in the country. It is not secret. It is not hard to find. Almost nobody reads it. As of the week ending July 15th, 2026, American banks held $19.47 trillion in deposits. That's your account and everyone else's added up. Now here's the line right above it. Cash assets, $3.12 trillion. That's everything the banks count as cash. Notes in the vault, balances at the Federal Reserve, all of it. 3.12 against 19.47, 16%. So for every dollar sitting in every American bank account, there is about 16 cents of actual money behind it. The rest is on the other side of the page. 13.9 trillion in loans, 5.8 trillion in securities. Somebody's mortgage, somebody's car, somebody's business. Your deposit isn't in a drawer with your name on it. Your deposit is a promise, and the bank spent it. And before you assume the 16 cents at least exists as physical cash, it mostly doesn't. Total currency in circulation is 2.37 trillion. Total money supply, M2, is 23 trillion. 90% of the money in this country has never existed as an object. It is a number in a database. That's it. Okay, so the bank lends out the money people deposit. That's the part everyone thinks they already know. It's wrong. And it isn't wrong according to some blogger. It's wrong according to a central bank. In 2014, the Bank of England published a paper in its Quarterly Bulletin called Money Creation in the Modern Economy. 3 economists' official publication. They wrote this: one common misconception is that banks act simply as intermediaries, lending out the deposits that savers place with them. And then the correction. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. Read the order again. The loan comes first. The deposit is created by the loan. When a bank approves a mortgage, it does not go find $400,000 in a vault. It types $400,000 into the seller's account, and it writes a $400,000 loan on its own books. 2 new entries, both created in the same second. Neither of them existed before. That is where the money in your account came from. Not from a printing press, not from Congress, from somebody, somewhere, going into debt. Now, the obvious objection: there must be a limit. The reserve requirement. The rule that says a bank has to keep a fraction of its deposits on hand. That's the whole idea of fractional reserve banking. So let's look it up. The Federal Reserve publishes the reserve requirement on its own website. Net transaction accounts, 0%. Effective March 26, 2020. Not a low fraction, not 10%, 0. There is currently no legal requirement for an American bank to hold any portion of your deposit. The thing everyone calls fractional reserve banking has, in the United States, no fraction in it. So if every deposit was created by a loan, there has to be a mirror. Somewhere opposite that 19 trillion, there has to be the debt that made it. There is. It's on the same page of the same release. Loans and leases held by American banks, $13.9 trillion. Real estate, mortgages, office buildings, Apartment blocks, 5.81 trillion. Business loans, 2.89 trillion. Auto loans, 521 billion. Credit cards, 1.08 trillion. Every one of those numbers is a person making a payment this month. And every one of them, at the moment it was signed, created a deposit in somebody else's account. The mortgage created the seller's balance. The business loan created the supplier's balance. The car loan created the dealership's balance. The Federal Reserve tracks the household side of this in a separate release, G19. Total consumer credit in America, $5.15 trillion. Credit card balances alone, 1.34 trillion, and 1.19 trillion of that is sitting on bank books. So look at what that actually means. The same institution holding your savings account is holding somebody's credit card balance. And that balance is what put money into a third person's account. Your savings, their debt, a stranger's paycheck, the same event seen from three sides. Which is why these two numbers move together. When lending expands, deposits expand. And when lending contracts, money disappears. Not metaphorically. A loan repaid destroys the deposit that the loan created. The money stops existing. That's the part that's genuinely hard to hold in your head. The money supply of the United States isn't a stock that somebody manages. It's a byproduct. It's the residue of millions of separate decisions to borrow. And it shrinks every time one of them is paid off. Which brings us to what the bank pays you for the privilege. The FDIC publishes the national average deposit rate. As of this month, savings accounts 0.38%, interest checking 0.07. Now the other side of the same balance sheet. The Federal Reserve's G19 release average credit card rate across all accounts, 20.94%. Same institution, same dollar, 20.56 points of spread. And the bank doesn't even have to lend it to earn that gap. The effective federal funds rate right now is 3.63%. A bank can take your deposit, do nothing with it, park it at the Federal Reserve, and collect 3.63 while paying you 0.38. Zero risk, zero work, 3.25 points. Across the industry, that spread has a name and a number. The FDIC calls it net interest margin. Last quarter, it was 3.31%, and American banks reported $80.5 billion of profit in 90 days. None of this is hidden. It's in the quarterly report. It's just written in a language nobody's paid to read. So a natural question, if only 16 cents on the dollar is actually there, what happens if everyone asks for their money on the same day? We know exactly what happens. It happened 3 times in 52 days. March 10th, 2023, Silicon Valley Bank fails, $209 billion in assets. 2 days later, Signature Bank, $110 billion. 7 weeks after that, First Republic, $212 billion. $532 billion of bank gone in under 2 months. None of them were frauds. They held real assets. They just couldn't turn those assets into cash fast enough to hand it back on demand. That is the entire failure mode, not theft, timing. And this is where the insurance comes in. The $250,000 guarantee, the thing that makes all of this feel fine. So let's size the fund. The Deposit Insurance Fund holds $157.4 billion. Insured deposits across the country total $11 trillion. That is a reserve ratio of 1.43%, 1.4 cents behind every insured dollar. And insured is doing a lot of work in that sentence. Of the $20.7 trillion sitting in American banks, only $11 trillion is covered. 47% of the deposits in this country have no insurance at all. Those 3 banks in 2023 cost the fund $34.5 billion. 3 banks, 22% of the fund. There are 4,278 of them. None of this means the system is about to collapse. It means something stranger. The system doesn't work because the money is there. It works because we don't all ask at once. Every account balance in this country is a claim on the same shared pool of assets that were long ago converted into somebody else's house, somebody else's car, somebody else's business. It functions perfectly, right up until enough people try to check. So the number on your screen isn't storage, it's a queue position. Next video, credit card companies don't make their money the way you think. The interest isn't the business.